You might believe that once the Fed cuts rates on December 1st, the market will skyrocket and all problems will magically vanish. But I'd urge you not to jump to conclusions just yet. Today, I'm going to reveal a harsh truth that most people are overlooking. This highly anticipated rate cut could very well be a carefully laid honey trap, while the real opportunities are hiding in the corners everyone else is ignoring. Lately, market sentiment has been on a roller coaster. On one hand, GDP figures seem okay. On the other, job openings have been shrinking for months, with average monthly new jobs falling to just 62,000, far below a healthy level. This glaring contradiction has even the Fed admitting the challenge is enormous. So, every time US stocks dip, the market instinctively pressures the Fed to turn on the liquidity taps. According to CME Group's FedWatch tool, the probability of a December rate cut surged from 35% to 70% in no time, as if a rate cut were the guaranteed lifeline everyone's counting on. But have you stopped to ask, if rate cuts are such a cure-all, why are the economic numbers so contradictory? The core of the problem isn't a matter of a few tenths of a percentage point in interest rates. What we're witnessing is a profound structural shift underway. Companies are pouring money into AI. Data from Boston Consulting Group shows that for every R&D job created in AI today, 2.3 traditional jobs are lost due to automation. This means the very engine of our economy is being overhauled. Trying to use interest rate cuts, a traditional tool for stimulating aggregate demand, to fix this is like trying to treat a genetic disorder with insulin. It might ease symptoms temporarily, but the root cause, structural unemployment driven by technological displacement and policy uncertainty, remains untouched. What's more, let's not forget the elephant in the room. Has inflation really gone away? The core PCE price index in September remained stubbornly high at 2.7%, solidly above the Fed's 2% target. Wage growth is still running at a persistent 4.1%. Cutting rates now under market pressure would be like playing with fire next to a powder keg. It could easily reignite inflation expectations. It's a classic lure them into a trap scenario. You get a brief illusion of easing, but the price could be much more aggressive and painful policy tightening down the road. The Fed's independence is the bedrock of its credibility. The moment it lets market swings dictate its decisions, the effectiveness of its policy is significantly diminished. As Fed Governor Waller noted, the current contradictions will ultimately resolve one way or another, either through an economic slowdown or a jobs recovery. But this process will be anything but smooth. So, how should you position your portfolio amid this complex game? Let's start with the US dollar. A rate cut may put short-term pressure on it, but don't assume the dollar is headed for a structural collapse. In a global race to the bottom economic environment, the dollar's foundation as a safe haven currency remains unshaken. The 100 psychological level will be fiercely contested, and the greenback is likely to show surprising resilience, like a cornered beast fighting back. The biggest opportunity, however, may lie in gold. While the market remains fixated on the will they won't they rate cut debate, gold's underlying narrative has quietly changed. It's no longer just a hedge against inflation. It's becoming the ultimate insurance against policy missteps and currency credibility risks. If the Fed indeed falls into the preemptive rate cut trap, and subsequent data proves inflation is stickier than expected, forcing a sudden policy reversal, doubts about the central bank's credibility would skyrocket. In that environment, gold's monetary attributes would shine. If spot gold can decisively break through and hold above key resistance levels, a fundamental-driven rebound could be right around the corner. So, stop staring at that one date in December. The real rules of the game have changed. Focus instead on the actual trends in employment, wages, and core inflation over the coming quarters. They will tell you how this puzzle of jobless growth will ultimately be solved. When everyone else is swept up in the euphoria of expecting rate cuts,